Good evening, everyone, and welcome to Admiral Markets webinar. Today, Chris and I will show you advanced trading methods which are based on Fibonacci. So those methods that are based on Fibonacci are probably in some way unique, and you will find it probably useful in your trading. And after I show you my two methods, which are called double Fibonacci and Gappy with Fibonacci, Chris will show you our unique tools that we have developed also for trading advanced Fibonacci methods. So pay attention and we can start. Online educational materials are available at Admiral Markets Estonia for a global audience. So please take into consideration that information is not suitable for everyone. If you want to get corresponding information, visit www.admiralmarketsglobal, select your country and contact an appropriate entity. Risk disclosure statement stating all possible risks associated with Forex market. By accepting the risk, you're also proceeding further with us. Admiral Markets UK Ltd takes no responsibility for information accuracy. This is solely my and Chris' opinion, and in no way to present the actual suggestion for a trade. Forex is risky, take it as that, and this webinar is for information and educational purposes only. By logging into your Admiral Markets Traders Room, you can download Admiral Markets Supreme Edition, which will greatly enhance your trading. Also, you can visit a web trader platform by going to this address, and you will see that web trader platform is actually a safe way to use MT4 trading if you are not able to actually trade from your PC. So web trader will help you in a way MT4 does. Admiral Markets webinars are on our standard web address, and don't forget that you're officially trading with best MT4 broker. Who is Fibonacci? Introduction to Fibonacci numbers, double Fibonacci confluence, and Gappy, moving average, and Fibonacci. So that is what we will cover today. I don't need to mention who Fibonacci is because a lot of times in the past we have mentioned it. Leonardo Fibonacci, famous mathematician for his book of Fibonacci, and so on and so on. I won't bother you with such facts because you already know who Fibonacci was. And the thing is, we want to cut it to the chase and explain most important parts for the webinar. If you're still not sure who Mr. Fibonacci was, well, you can visit one of our previous webinars regarding Fibonacci numbers and you will find additional info. Today we will focus on practical things, not just on theory. So, Fibonacci ratios. These are most important Fibonacci ratios, and probably so far you have you know that my favorite Fibonacci retracement is definitely 88.6. So 78.6 and 88.6. The thing is that golden ratio is deemed to be the strongest of the support lines, but in theory it's not always like that. I personally have noticed that much stronger is 78.6 or 88.6, especially if we have a deeper retracement. I'm not saying that 61.8 is not good enough. It's good. It's a golden ratio. But very often you will find that 88.6 is actually even better than 61.8. And you know that we use both 78 and 88.6 for high momentum trading. You know that already. So definitely 78.6 and 88.6 are favorite Fibonacci numbers. Okay, guys, sorry for this, my nose is a bit clogged. So when you draw Fibonacci, you are actually drawing the swing. We always make our Fibonacci retracement or a swing from left to right. We never ever go from right to left because we don't want to follow the present into the past. We want to follow past into the present. Because of that, we draw our Fibonacci from left to right, always from bottom to top in uptrend and from the top to the bottom in downtrend. Okay? Don't forget it, because I know that still, despite all of the information Chris and I have been providing you with, Some traders still think that they can draw Fibonacci from right to left, which is totally wrong. Don't forget, guys, why am I saying this? Because if you take a simple Fibonacci numbers, 1 plus 2 equals 3, right? And 2 plus 3 equals 5, and so on, right? If this is the past, this is the present, this is the future outcome. So you want to combine past and present to give you the future result. Forex trading is the same. You want to watch the past, combine it with present, and it will give you a future outcome. That is price action. Okay? Same here. If you were watching 2 and 3, let's say that now you're watching 2 and 3. 2 is past, 3 is present, 5 is the future. Okay? Always like that. And those numbers will spin up, but you need to remember, past and present will give you the future outcome. Bradley is asking, so for uptrend bottom to top and downtrend top to bottom? Yes. Okay, from left to right. This is your left, this is your right. Okay, so in uptrend, in uptrend, from the bottom to the top. Okay, and you will see these Fibonacci numbers. Of course, you need to add 78.6, Bradley, and 88.6, because 78 and 88.6 cannot be found on MT4 by default. You need to add it manually. Don't forget it. Here, the same thing. From the top to the bottom. Okay, from left to right. Okay, from left to right. Never ever from right to left. This is how it goes. Okay. Now, 38.2, 56.1.8 are standard Fibonacci numbers. Okay. 78.6 and 88.6 should be entered manually, and I will show you now how to do it, because I know that some traders still are not able to do it on their own. So this is how I do it and how you should do it too. Let me open the chart for you. Okay, so here it is. Go to your Fibonacci tool, for example, like this, right? From left to right, the retracement has already started. 23.6 has been touched. We want to see the reaction at 38.2 for all of you who are watching dollar Swissy. Now, this is confluence point, so we will see. Now, what do we do now? Go to objects list, then find a Fibo here, and you see those are numbers, level and description. In the level field, you should add like this, add, and type it 78.6 and here 78.6. Same for 88.6. In the level field, you type 0.886. In the description field, you will type 88.6. Okay? When you do that, you will see that 78.6 and 88.6 have been added to your MT4. Okay? Because MT4 is not showing these two by default. Okay, so I hope this is clear, so we can continue. So retracements are percentages of AB move swings. Okay, we are calling it C's. It's simple, ABC. ABC. So C's or C is a percentage of retracement, AB move swings. Fibs are always drawn from A to B, always from A to B. Okay. And A is always 100% and B is always 0%. Okay, like this. Always 100%, always 0%. Okay? Always 100%, always 0%. A, B, B, A, depending on the move. This is the explanation of simple Fibonacci tool used in uptrend. From A to B, from left to right. C is the percentage of AB move. And this is what I'm telling you guys. Very often you will find that 78.6 and 88.6 are actually very, very powerful. And if you still remember how we teach you to trade high momentum trading, you know that high momentum is really based on 61, 78, and 88.6. And 78 and 88 are definitely our favorites. 88.6 may fool novice traders to think that actually this will be a reversal. In the reality, 88.6 is just a deeper retracement. It's not a reversal. Don't forget it. It's not a reversal. Now, when price gets from A to B and starts to retrace, the first thing how you can spot a retrace is by watching next candlestick. If next candlestick does not print in uptrend a higher high, you can assume that the retracement has already started. The thing is, if you are watching AB move, the thing is that in this, I can say a mini rectangle, this is a mini rectangle, a consolidation, you can easily define retracement. This is where retracement has started. This candle could not printed a new high, and actually this is when retracement began. And you see how the price is retracing. And it will always have some reaction at Fib. At least 1 or 2 pip it will bounce. Now you want to see where it will really bounce, not for 1 or 2 pip, but for at least 20, 30, 50, 100 pips, depending on time frame, of course. And this is it. You see, the power of 78.6 and 88.6 is very, very strong. Same here, guys. From A to B, downtrend. From left to right, from top to bottom. Okay? Like this, from top to bottom. This is the lowest low, and here we might assume that the retracement has started. Once this candle closes, you might start drawing a Fibonacci retracement tool. So this will be a signal for you to actually put a Fibonacci retracement tool and start to follow a possible trade. Again, guys, watch the reactions. 38.2 reaction, 50 reaction, 61.8 reaction, 78.6 reaction, probably 88.6 too. So the price should always react. But I really prefer 78 and 88.6, and occasionally, yes, I love also 61.8. I cannot say I'm not a fan of 61.8. But sometimes we can really get a better price. It's risky, I know, because you are waiting for 78 and you might miss a trade. But you have 20 pairs to trade, and it's always good to try to long or short around these levels. So you should always follow 78.6 and 88.6 on your charts, guys. So this is very important. Follow it. This example also shows you 61.8, perfect rejection. A, B, C. Look at reaction. A pin rejection of 61.8. Golden ratio. uptrend from bottom to top. A, B, and this is your swing point. Again, 788.6. So 78.6 and 88.6 are a little bit close, but both are powerful. 88.6 is connected to some astronomical numbers and the universe itself. Don't forget that 61.8 is also our galaxy, Milky Way. Now, two tips which I will be showing you are double confluence and Gappy moving average. I will be showing you exactly step-by-step tutorial how to find double Fibonacci confluence and Gappy moving average confluence with Fibs. I know that some traders do this and use this for bounces. Okay. So first a double confluence. Okay, double confluence. We will use that. This is double confluence. Bradley is asking what is a confluence. A confluence is where two or more technical tools unite to give you a good entry. Confluence is, Bradley, what you've been reading every day on technical analysis articles which I publish with Iron Markets. POC is a point of confluence. So it's not a stupid question. It's a good question because you don't know what a confluence or POC is until I explain it to you. So a confluence is where the point where two or more technical tools unite to give you a better confluence, to a better entry. Net is saying that audio lost, but I think audio is fine because I don't see that audio has been lost. So I think audio is fine, guys. Can you just confirm that you can hear me? Yes, Beverly, Bradley, Ron, yes. So the audio is okay, guys. I don't know, Nat, let's reply. Okay, audio. Okay, so Bradley, is it clear? Confluence is where two or more technical tools unite to give you a better entry. It's like POC. It does not need to be an entry. It can be also the spot where you expect some reaction. So when you see POC in my articles, it usually will show you a reaction. Okay, reaction, I put it usually for entries, but we can usually expect a reaction there. For example, I will show you GBP dollar analysis yesterday, which I did yesterday. So you see it here, very clear, very straightforward. POC is here, also here. So these are POCs. Price came here to this POC and rejected. This was another POC. So those are spots where the reaction is expected. Okay. So that is POC, point of confluence. So confluence in Fibonacci means that two Fibonaccis are giving you a potentially strong zone. So you need to have a longer Fibonacci and shorter Fibonacci. It looks like this. Drawing a Fibonacci from this point to this point, and from this point and this point, and you find a confluence. These are confluence spots for double Fibonacci. Same here, from the bottom to the top, but the range of this first Fibonacci is higher. So this was on 1st September, and this is on 4th September. So basically, tops are the same in uptrend, but bottoms are different in uptrend. Okay, you can see a confluence here of 50 and 23.6. Okay. Now let's use it on, let's see it on live chart. How we actually make it. I will show you now. So if we would place a confluence point here, we would use two most important Fibonacci's. Let's say for 1 hour chart. So for this day, this is a swing low and this is a swing high. Most recent Fibonacci is this one, swing low and the same swing high. And look where the confluence is. The strongest confluence is around this zone here, because 50 and 38.2 are strong. See, so this is double Fibonacci confluence. So I might assume that if the price gets here, it will react. It should bounce probably from this part. Beverly is saying, when you look at different fibs, would you look at daily and hourly, or how far apart would you have time frames? No, it doesn't go like that, Beverly. The point is, just for example, if you use it on 1 hour chart, you need to pay attention to daily swings on 1 hour chart and most recent swings. Let's use, I don't know, let's use pound dollar, 1 hour chart, pound dollar. So daily Fibonacci is definitely where our day starts, right? Okay. So let's mark it with, okay, like this, 21st. Okay, 21st, 00. And go back in the past just a little bit. Okay, and you can see it here. Okay, you can also do quadrants like this, but I personally love to prefer 1 or 2 days on 1 hour of price action. So this is it. Let's say that this was swing high, obviously, and this was swing low. So you go like this. Place the first Fibonacci from swing high to swing low. And let's say that you don't know what happened here, so we will be using most recent swing points. So most recent, because we cannot go in the present, we need to go in the past. So most recent for this day would be this one and this one. This one and this one. Okay? And you can see that where the confluence is strongest, it's where these points unite. So 50 and 61.8. Look how close those are. And look, these are a bit spread, but these are the closest. So this is the strongest confluence. And look at this. The strongest rejection was here. Price came here and was rejected. See? Not bad for naked chart. 25 pips rejection. Every other candle was breaking through it. There was no reaction. Okay? Dollar CAD, for example. Now I need to use blank. It's too clogged. I don't like when my charts are not clean. Okay? Again, why not? We can do this once more, then I will move to Gappy. Okay? Mark the beginning of the day, which is 12 o'clock. Okay, most recent swing definitely here, definitely. From the top to the bottom. Now, obviously we don't have a clear swing as of yet. We have this one, but this candle has not been closed. So I don't know if this candle will close as a signal for retracement. If this H1 candle closes like this without making a new low, this will be a signal for me to draw a Fibonacci. In that case, I would put it like this. Where is the strongest confluence? Here we have very strong confluence, and here we have also very strong confluence. So these are two spots. I would neglect all these. So this is no confluence for me. Only these two. This one and this one. So use these tricks. It's good. You will probably like it. Double Fibonacci confluence as I showed you. Now, we will move to Gappy MA. So trading signals are usually identified as multiple crossovers. Okay, so Gappy are a combination of moving average, which can give us a trend. A trend is identified when the lines of the long-term traders are spread out, the lines of the short-term traders are spread out, and there is a growing gap between the short and long-term traders. This signifies an agreement between short and long-term traders. Short-term traders always initiate a trend, but they need the support of the long-term traders in order to keep it going. So this is Gappy moving average, and you see a combination, okay? This is a combination of Gappy. How do we put it on our charts? I will show you a tutorial step by step. Okay. Let's clear this chart. First, now pay attention. We need to, okay, indicators. And the first number is 3. We will use a combination of 6 short-term EMAs and 6 long-term EMAs. 3, and let's use red and blue. 3, 5, 8, 10. Those are all simple. I will just move it to EMAs. So every single of them should be EMA, not simple, but exponential. Let me put it one more. 18. So once more, exponential moving average. 3, 5, 8, 10, 12, 18. So those are short-term moving average. Now let's use a longer-term moving average. First one is 30. Exponential, but blue. 35. 40. 45 is next. Then we go with 50. 60 also. Here it is. So this is how Gappy looks like. Now let's move on. So usual combination of GMMA include EMAs. GMMA means Gappy moving average. 3, 5, 8, 10, 12, 18, 30, 35, 40, 45, 50, 60. Some traders love to call it rainbow as it resembles the rainbow. I don't call it rainbow. I call it Gappy moving average. A rainbow is slightly different. Okay? So this is what we do. We just switch the colors. It doesn't matter. We use Fibonacci. This was actually a kind of system, but it's actually a trick where you can see how Fibonacci goes with the trend. So the first rule is wait for fast moving average to cross slow moving average. Wait for a pullback to EMAs. Wait for the price to retrace and hit multiple Fibonacci levels and enter a bounce trade. This is step 1. So this is a crossover. Step 2 is drawing 2 Fibonacci's. from last swing and previous swing and find a confluence point. So now we use double Fibonacci confluence with Gappys. Here you can see that basically price has crossed here, so we just need to define double Fibonacci confluence. So two most obvious swing points are these ones and okay. So we want Gappy red to be below blue and to hit some of those strong levels. For me, let's say that in this chart, best confluence is seen here. We have also a confluence here, but it's too high. For that occasion, we need to use 15-minute. So 15-minute moving average will usually work the best. Okay? Here you can find it more clearly. Okay? And this is where we have a confluence at this spot and not that big in this spot. But in order to define a proper double Fibonacci confluence, at the time when price hits these confluence spots here or here, red still needs to be below blue, else a trade setup will not be valid. Okay? That is why this is the best seen on 15-minute time frame. Same here, guys. Look at this. It's very obvious what the price has been doing here. Very obvious. Okay? So let's use it like this. You place Fibonacci retracement. Let's say that you want to trade this one. So this was the most obvious swing. And this was the latest swing. So your entry would be here. How you define your entry? Well, it is not that clean now because Gappy is, but I want to show you the trick. Ron, I don't use this because it's not my method. This is an old trick from Forex Factory 6 years ago. It's not my method. But maybe for some of you will be interesting to see this. Because here you can see, when you see a pin rejection from confluence point, and this is clear confluence point here, 61.8 and 23.6. Even here, and if red is still above blue, you can say that this is a good for long trades. No, MJ, we don't look at Fib extensions because Chris will show you maybe something better than Fib extensions for targets. Chris will show you that, don't worry. So this is, I'm focused more on entries now. So pay attention to this. This was a great confluence point. Look, 61.9 and 23.6, very close. And here the pin was formed. After the candle closed, red were still above the blue. So this was a valid entry. Okay, guys, my time is already, I'm already out of my time. So Chris will continue now. And he will show you also other tricks with Fibonacci trading. I advise you, it is not clean, but it's good to try it. Maybe it will save you some trouble in defining some of your entries. It's a trick, nothing more. Okay? So thank you, and now Chris will continue.
Yeah, thank you so much, Nanette. Good to see everyone here. We're going to continue with this webinar once I get the charts, my screen set up, and it should be pretty soon. There we go. I hope the sound is okay. Good to see you, Beverly. And if you could confirm sound is good, perfect. Thank you so much. So before I kick off with my part, we wanted to actually ask you for a little bit of a favor. I'm not sure if Nanette mentioned it. I missed part of his webinar. Is that FX Street nominated Admiral Markets and Nanette himself for analysis and speaker in 2015, the Forex Best Awards. So if you would like to help us out, you could by going to this link basically and voting on Admiral Markets in question number 2 and on Nanette in question number 6. and it's valid today up to next week. And basically there will be about 8 categories. If some categories you don't know, it's okay to click I don't know, but you have to complete the form if you would if it counts. If you don't complete it, it doesn't count. That's the requirement, but you don't have to fill in an answer for each one. You can choose I don't know. So would love your vote on both of us. Admiral Markets posts analysis on FX Street, Nanette and I myself, so we really appreciate that. All right. So today we're going to take a look at Fibonacci, taking a look at confluence. Nanette already mentioned it. I heard confluence and points of confluence. We're going to dive into that. We're going to talk about the best swing highs and swing lows. We're going to talk about when it's time to actually place a fib, and we're going to take a look at Fibonacci patterns and targets as well as the last step. So we're going to gather a lot of good stuff, I think, coming up. We're going to first of all dive into some example here of how to find confluence. You can see obviously that you can use different methods for finding confluence. You could use a fib and a trend line as indicated in this screenshot here below. And for instance, at this point, you can see a confluence between the 78.6 fib and a trend line. And I've mentioned already the advantage of trading deep fibs. 78.6 fib is a deep fib as well. And this was actually a live scenario, live case that we looked at in a webinar, live webinar, not so long ago. There was a big wick, big pin bar at this fib. That's a clear reaction. That could have been a short setup, and we were talking about the potential for that to happen somewhere down in here. So that is a confluence, but what I want to talk about today is a bit different confluence. I'm actually talking about confluences by using multiple fibs. Nanette actually just gave an example where using the 23.6 and the 61.8 fib, I think. So using 2 fibs, these are 2 retracement fibs in this case. Another way of using confluence is by using a fib retracement and a fib target. So basically one fib would be from top to bottom, from bottom to top, excuse me, and the second fib would be from top to bottom. All right. So one fib is basically a with the trend fib, and the other one is more corrective fib. What we're looking for is the correction to end. So when the corrective fib has targets, they often line up with the retracement fibs. And most of the time, there are 2 zones that are most likely to be used for a bounce. Either of these 2 could be the bouncing spot to get the trend continuation or to get a decent bouncing area. So what you'll see is a minus 61.8 target, and I say minus 61.8 target, all right, together with a plus 61.8 retracement. Now, if you're wondering what are minus targets, then basically what I do is I add a minus number so that there's a target below the fib or above the fib. All right, that's how I do it. It's a different way of doing extension, basically. So I don't have to draw an extension on the chart. I only have to draw the retracement tool, and I get retracement fibs, but also targets in one shot. Saves time, makes it easier. So from that point of view, I like this way of using a minus figure. So often enough, these minus targets will line up pretty accurately with the retracement fibs, and these are great levels for continuations. Actually, this week we had a good one, I think, on the dollar CAD before it started to crash. Actually, there was one more potential buy that we talked about on Wednesday, I think it was, where I was saying, okay, I put a fib on this move. This is a corrective move. And this was a correction as well. And I said, okay, if it gets down into these targets around the 23.6 and minus 61.8 target, there's a confluence between those 2 and the retracement fib. That could be an interesting bouncing spot. It missed the target by maybe 10, 15 pips, but the idea is still clear. You got confluence between the target and the retracement for a trend continuation. It made one more higher high at about 147 before we saw an impulse come in, and we saw a correction and yet another impulse, and we see a bigger ABC correction take place. And one of the things that we could do in that case, when you see a correction, a big zigzag like this, is try to trade that zigzag. But this is a more advanced trade. It's a corrective ABC zigzag. All right, let's go back to the, but that's an example of an upside continuation there. So we need to, how to do this is basically we're looking to put a fib on the swing high that represents the trend from top to bottom, and then we need to find a retracement, basically, a correction that goes against it, and we put the fib on the first leg of that correction, and then we look for the third leg to end somewhere at that target. So if you have a with the trend setup and you got a corrective leg like this, you can put a fib on both legs, and what will happen is you get another correction, and then boom, you get the trend continuation. So by putting a fib on the green arrow and the first red arrow, you get that confluence. All right, let's move on. If you have any questions, please let me know. And there is the link, by the way. I think Nana posted the link there. So if you want to vote later on, you can do that. Let me quickly copy it for everyone. I'm not sure if everyone can see that. Good, there it is. All right, let's move on. So swings. I'm going to talk a bit about where to place that swing, and I think this will be pretty brief, but basically I'll dive into that a bit later on. What I like to do is just find a piece of momentum. Most of the time, whenever the momentum is present, that's a pretty good swing high, swing low to place a fib on. Most of the time, that's actually where price will not break the bottom. If you start putting the fib on corrective pieces, it's getting a bit more difficult because at the top or bottom is just not as secure. Plus, often enough, you just get a kind of a range or a reversal. Whereas if you have a clear momentum, whatever the correction here is and how deep it goes, we don't know. But there's a good chance that if it is a correction in the red circle and we have a green arrow and then we have a momentum prior to that, there's just a decent chance of one more continuation. Of course, there are going to be cases where we don't get the follow through and there's maybe a bigger reversal. So it's good to take a look at one time frame higher and what is that time frame saying? Is that time frame in an opposite trend? Is that time frame in a downtrend perhaps, right? Well, then maybe we won't get that the second green arrow. Those are things to consider. But on average, you got a decent chance if you find momentum, you put a fib on that. All right, let's talk a bit more about when to put the fib on. We have a lot of webinars already in the past about fibs. Basically, I want to talk about, if you see a momentum occurring and candles are posting higher highs and candles are posting lower lows. For instance, what's happening now on the dollar CAD, we're seeing a pretty strong retracement, right? And all these candles here, let me get rid of these fibs a bit because it's maybe a bit crowded. All right, there we go. So you're seeing all these candles right in here, they're having lower lows, right? Each candle almost is pushing lower and lower. So when that happens, often enough, it's good to zoom in. I mean, we can put a fib on this swing, I'm not saying, like Ned already said, but basically what's happening is that this particular time frame is in a momentum. So the chances of a very deep pullback are less high. So by looking at a lower time frame, by looking at, for instance, a 5 or 50-minute chart when an impulse is happening, there's a chance to get a smaller pullback within that momentum. Now we don't want to do that forever, right? Because there's going to be a point where if we start fibbing a small part on this 5-minute chart, you get a bigger correction and that, boom, that 5-minute fib is worth nothing. You can throw it out the window and you got a loss on your account and my account. So that's why we need to look at divergence, which is a different concept again than fibs, but it's good to know about divergence. Take a look at some other webinars with divergence, because when you get divergence, that's when you want to zoom back to an hourly, for instance, then be more careful with using smaller fibs because then a bigger retracement could occur. We don't have divergence at the moment, all right? But if it is, you want to be careful with trading lower time frames. So if you see an hourly momentum occurring, right, like this, or whatever time frame for that matter, and you see this break of the bottom right in here, for instance. So let's put a, just to give an example right here, a horizontal line. That was the moment of the break. Actually, it was probably a bit, let me check. No, it was a bit later, I think, somewhere in here. Anyhow, when price breaks through this bottom, let's say, then we can put a fib from these mini bottoms to these mini tops like this, right? Now, this is a very risky practice. Make sure that everyone understands that this is something that could go wrong easily if we're not in a momentum, because then price could make an easily a bigger retracement and you get stuck with a 5-minute trade or 50-minute trade, right? That is just kind of selling at the bottom or selling at the turning spot. But if there is a good momentum going on, and you got good candles, good strong candles pushing forward, then there is a good chance that this momentum just continues. But I would say it's definitely an advanced technique. Well, that's why we have it, of course, as an advanced webinar. So, it's a 50 fib, boom, down to minus 61.8 target. So from that point of view, we can move this fib again, 38.2 fib, right? Boom, 2 targets. Can move it again, here. That's the next fib. So we're going to get a turnaround at the 50 fib? I don't know. There's no divergence at the moment, at least. But obviously, it could retrace to deeper fibs as well. It could break this top as well. We never know, right? It's a 5-minute world, so it can do anything at once, really, obviously. But there is a good chance, considering the 1-hour momentum, that this could find resistance. Maybe there's a candle higher as well, so maybe at these fibs, anywhere around the 50, 61, 78.6 fib, could be a turning spot. Now, the other way could be just to put a fib on these hourly candles, right, as well. When the momentum is really going well, it could be another option. Right, by the way, regarding time frames, one small note is that I was saying that I can put a fib on this piece, and I put a fib on this piece, and I found confluence here. Remember that part? You can do that on all time frames, in fact. You just need to be aware that the lower time frame, the more vulnerable you are to influences from higher time frames. Okay, but this could even be done on a 50-minute chart. I mean, in this case, I don't think there's a good example, but no. Okay, so forget it. But I wanted to say basically that one could even put a fib on like this here on this swing high, swing low, and you can see that there's a confluence between these targets. Now, price never got there, and that sometimes can happen, like we see here. That price doesn't get up to those targets and just uses the shallower retracement. And that's why still, being on the lookout for breakouts is something of a backup kind of plan. But that's, again, a different topic than Fibs and a different webinar area. All right. Let's go back to this. Now, what happens if a couple of candles do not continue with that momentum? And my rule is about 6 candles. When that happens, I use that time frame. So let's say on the 1-hour chart, we have 6 hourly candles not breaking at this bottom. Then I would definitely use this hourly chart and not a 5-minute chart anymore, and start to place fib on this swing high, swing low properly. And that depends if the target got hit. More on that later. Yes, it did. So I would probably then, in that case, use this one for the moment. All right. Now, let me give you an example of something that already has happened, so it makes it a bit easier. Here, we got 1, 2, 3, 4, 5, 6 candles, not broken, right? So at this point, I am not going to be fibbing anything on the lower time frame than an hourly because the momentum to the upside is over. So I won't be fibbing anymore on lower time frames. Well, in fact, I wouldn't even fib it on the hourly because there's only a single divergence. Okay. So I thought there was a double. If there's double divergence, I wouldn't put a fib on it anyhow. So the point is that when you get an impulse like this, where I have the green kind of sections here, I am okay with zooming in and using lower time frames. If there's no like daily resistance close by, etc. If that momentum is over, then it's better to stick to the hourly until we get a breakout. So once we get 6 candles not breaking, okay, fine. I'll put the fib on this swing high, swing low. Right? I'm not going to use a smaller fib, a smaller swing. I'll use this swing, and boom, 38.2 hit up to the first target. Once we get a new swing high, new impulse here, I can zoom into lower time frame, and then we pause again here. So okay, I'll use that swing high then, right? Not a shallow, not a deep fib. 23.6, not tradable. I won't trade a shallow one like that, but I will trade potentially the breakout. All right, so we reached the target. We got 5 to 6 candles not breaking it. Well, actually, let me dive in here. 1, 2, 3, 4, 5, 6 candle here. So the bounce already happened. But the good thing is that within this part, I would probably be still fibbing smaller swings. Now, there is a risk, of course, that if the swing is too small, that's something you got to be really careful of. That if there's divergence, that you don't start fibbing a smaller swing, because then if you get a bigger correction, it could be running into trouble. All right, what I consider a major swing is when basically 5 candles or 6 candles do not break a bottom or top, and 13 candles, that's a major swing. All right, so here one more example. Basically, you got a good, just to make sure maybe that it's clear, this is a swing high, swing low. We know now, but at the moment when the candles are making higher highs, higher lows, it could be a good moment to zoom in and try to catch a piece of that part to the upside. Then we see 5, 6 candles not breaking it. Party is over. Don't zoom in. Stay on the hourly chart. Put a swing fib from here to here and look for the retracements. We get the retracement and get another impulse. So as you can see, impulse, correction, impulse, correction, impulse. So alternatively, lower time frame fibs with the blue arrow, red arrows, bigger swings. Sorry, I'm mixing it up. Excuse me. One more time. Blue arrow, blue arrow, blue arrow. Those are when there's an impulse. We can zoom in. When there's no impulse, want to use the bigger swings again. All right, we're going to dive into some new topic because I went a bit, into more detail on this particular slice of the presentation that I had in mind. But I got one question, and then we're going to move on. Would you say with this dollar CAD, we would watch the 1 hour, and if it doesn't post a lower low in the next 5 to 6 hours, we would assume uptrend will resume? Let's take a look. All right. What do we got here? We got 4 hour chart, 1, 2, 3, 4, 5, 6. Okay, so this 4 hour chart could be ending a swing, and if we look at the oscillator as well, we're back at the 0 line. So we're probably going to have to put a 4 hour fib on from here to here and look for bounces in here, right? We don't have divergence on the 4 hour chart, so there's no reason, in my opinion, to necessarily think that the uptrend is over, unless on the daily chart there are 5 to 6 candles not breaking this top. All right, so we don't have that yet. So for the next few days, we can use the 4 hour chart, and we can use this swing high, swing low. Now the hourly could be bouncing at this 50 fib indeed, and if we then put a fib from here to here, yeah, we got some, some retracements as well, some confluences as well here. So yeah, it could be a good idea. Wait for a hook back, and it could be a longing area. There's only one kind of trade management thing I want to discuss with you, is that if price makes a triangle here, then it could be indicating a bigger reversal. And it could be good to move to break even or take the trade off, because in that case, there could be one more leg down. The triangle would be a consolidation. We've had strong impulses before, so a consolidation like that too long might get one more move down. So yeah, this could be a classical zigzag. In that case, it is bringing us back to confluence, and once we don't have the candles running in the momentum anymore, we're not continuing with the momentum anymore, there could be a hook back and a bounce. The risk obviously is that the momentum is quite strong and that it makes one more downside. So that's something that trade management might solve. If we do get a bounce here, then it depends how much we'll bounce here and how fast. Because if it takes too long on this daily, as I said, if it takes a few days here, doesn't move down, then I'm not using this 4-hour swing anymore, but I might even move the swing lower, this fib, not on the 4-hour, or I'll keep the 4-hour maybe, but even maybe use this daily fib. And then the daily fib, we're back at the 23.6 fib. So let's see. But for the moment, this fib is A-OK on the 4-hour chart, I think, personally. All right. Was a bit different, I think. Let me see. No, it was here. So that's a bit of extra info on confluence as well. So let's move over, as promised, so that you get some other perspectives as well. Move Fibonacci to the new swing once the target got it. If this is maybe a bit tricky with multiple time frames, when does the impulse start, when does it end, that could be maybe too advanced in some cases. Or maybe it's okay now, but if you want to implement it on a live chart yourself, then you might bump into some questions and you're not sure, right? So a maybe simpler method could be just to wait for the target, the minus 61.8 target, to get hit before moving the fib. For instance, here we're using a swing high, swing low, right? A completed impulse. So that's a bit easier. It's always easier to wait for, in a way, to wait for completed impulses. It requires a bit more patience, but I would say it's a bit easier because you got a clear kind of piece to work with. If you start, fibbing on lower time frames in this impulse, you really run the risk of fibbing the last part and then running into the consolidation here, like this. You see what I mean? So if you wait for that impulse to finish, you place the fib on, and then you start to look for those discounts when price reaches these fibs, right? Great. You can leave that fib on until price reaches this target, the minus 61.8. Don't move it. That's one way of doing it. It's easy, it's simple, it's straightforward. So, that's great. And even if it hits this target, it could be a good take profit point or partial take profit point, but don't move the fib yet, because people who do from here to here, they can sometimes run into serious problems, as you can see, because price retraces deeper. It bounced off a 38.2 fib here, but look at that. It retraces down to a 61.8. So if you use the green fib and you use this as a bottom, the blue circle, boom, a loss. You fib a corrective piece, a small piece of price action there without the blue arrow, and the bottom breaks, doesn't hold, retraces to a deeper fib, and that's the bouncing spot that does bring price up to the minus 61.8 target. So that's a more, I think, a more straightforward way, let's say, to use fibs. All right. Some patterns that you might see, we talked about this as well, so there's a bit of an overlap here, but sometimes you're going to see price extend through minus 61.8 target, especially if you're in a trend. With reversals or retracements, minus 61.8 target or minus 272 or minus 61.8 targets are great exiting points. But if you're in a trend, you might get continuations all the way up to higher targets, like the minus 61.8, right, on the left here. But with reversals, look at that ABC, right? Stops at the 272 target, ends up to minus 61.8 target. So you want to be aware of momentum extensions that happen more with the trend. Zigzag patterns happen more in reversals. And one more time, this chart, basically the shallow retrace, shallow target, right? Shallow, step 1, shallow retrace. Step 2, shallow target. Step 3, deeper retrace. Step 4, deeper target. Many traders call these things some kind of pattern names like crab and bat and stuff like that. All right, I'm not going to dive into all these names because we don't have time for it at the moment. But you can look that up. They're all kind of like different kind of formations that have different names. Last but not least, this is the Fibonacci sequence tool. There's been a separate webinar on this topic alone. So if you're interested in using Fibonacci sequences for targets, take a look at that webinar. It was recently in December 22nd, I think. You can find it by going to YouTube and going to Admiral Markets channel. And the Fibonacci, you can use the Fibs sequences. How? By using the numbers 55, 89 on the chart, by basically using those levels and counting pips from it. So you take a top like this, you subtract 89, and you get these levels here. And when price moves beyond a third level, which is on the 1 hour chart, 144, when it moves beyond 144 pips, without going back to the long-term moving average here, which is around 150, 144 to be exact, then there is a very good chance of an acceleration and an impulse. On the hourly chart, that level is 144. Once it passes 144, you'll see often an acceleration down to 233 pips, and then down to 377 pips, and sometimes even down to 610. Those are zones where price gets a bit more impulsive. Now, it takes quite a lot of time to place these lines on the charts, and you have to be precise. We made a tool that does that automatically. So that tool has been made by our website, and I have a website, Elite Currency. And if you're interested in that tool, you can do that through Admiral Markets and us by sending me an email right here. That's my email address. And it's a cool thing because of the fact that you have an idea where the bigger movements could occur. And when you have that, you could be a bit more patient with letting a trade go and being able to get a bigger winner occasionally, at least. And the cool thing about bigger winners is, the reward part of things. And if you, on top of that, have a trade management system that allows you to sometimes at least cut losses short, then that is if there is anything, that comes close to this so-called Holy Grail or Golden Grail or whatever you want to call it, then trying to catch a few bigger winners when you think there's a decent chance for that, not just randomly doing that. And if you're able to trade management smartly and manage to reduce the losses occasionally, then you're boosting the reward side and you're limiting the risk side. That's all great for the equity curve. So this is a Fibonacci sequence target tool. I love it. I really think it's very valuable. All right, so let me see, questions. You use this only for the trend trades? Yes. So a bit more information about this indeed. You want to use this tool when the moving averages, for instance, or when you see a trend and you're trading it with the trend. Personally, I use these moving averages, 21 EMA and 144 EMA, and I want to use it when to the downside when the moving averages are aligned to the downside. Now, often enough, sometimes you can even use it for retracements. When there's a retracement, let's say I put it on this bottom, because then it could be an interesting way to see at what level here there could be the turnaround for more downside. It's one way of, if you're really a fan, it could be a way of doing that, right? Or sometimes these levels are used as support and resistance, right? Sometimes you can see here a bounce, boom, and then you see. So they could be used in other ways as well. But the primary focus here is to see where that impulse could happen with the trend, indeed. And then I see Beverly's second part. And indeed, yes, it's something that is possible to see for confluence. Any other questions on any of the material previously so far? Oh, let's see. No, nothing yet. Well, if you have any questions, let me know still. Otherwise, please take a look at our website here. You can see some good information about what are the markets telling us. It's a fundamental article. And you'll see more webinars next week, of course. Same schedule on Monday till Thursday. All right. Last but not least, as said before, we would certainly appreciate your vote for us in the FX Street Award nomination ceremony for analysis and speaker, Animal Markets and Nenet. So thank you already in advance so much for that. Today till next week. The third level, by the way, is very important because everything above the third level is more of a range territory. And when you get beyond the fifth level, it could be a bit slower. As you can see here, the most impulse between 3 and 4, and between 4 and 5, and between 5 and 6, it kind of slows down like this. You see that could take a bit longer for price to reach that sixth level. It also depends on which currency pair are you looking at. Euro dollar is going to be slower between 5 and 6. And Aussie doesn't move as much. But the pound yen, a pound New Zealand, a euro New Zealand, a euro yen, those are just pairs that will have a bit more impulse. And in fact, in that case, the zone between 3 and 4 is a bit more, it actually shifts a bit. Whereas 3 to 5 is probably the most interesting on the euro dollar. I would say that on the pound yen, it could be between 4 and 6. And 3 and 4 could be still a relatively small zone for a pair like that. These are just a couple of things basically about this. Please, if you're interested, as I said, go to the webinar on a Pro Learning Lab webinar of December 22nd. Animal Markets YouTube, and there's a whole hour about this alone. If you're really interested, I definitely recommend it. Please take a look at that webinar, and that dives into more details. So thank you so much, folks, for joining today, and we're glad that you were here. We wish you good trading still tomorrow and also next weekend. Look forward to see you then, and have a good weekend. Cheers, everyone.